You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
There's so much reward from investing in silver. As I said, I talked about the gains that silver produced in the 1970s. 3,700% in the metal itself is a 37 times return. If you can get that in the metal in a massive silver bowl, it's certainly not unrealistic to expect 10 to 50, and sometimes even in some special cases, 100 times or more returns in some silver stocks.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Well, my guest today believes that silver could go to $300 per ounce, and he's the author of a new book, The Great Silver Bull, Crush Inflation and Profit as the Dollar Dies. I'm speaking to Peter Krauth of SilverStockInvestor.com. Peter, welcome onto the show for the first time.
Bill, thanks so much for having me. I'm really glad to be here.
You've referred to silver as the trade of the decade. Could you kind of give us a thumbnail overview of why you believe this? You mentioned it with that subtitle, how silver crushes inflation. That's so true. In the 1970s, silver was up 3,700%, easily doubling gold's return of about 1,400%, which is nothing to discount. That's for sure. But being the trade of the decade, I certainly believe that, because I also feel that, and this certainly goes hand in hand, that inflation is going to be the defining feature of this decade. Very much like the 70s, but I think even at an even more pronounced in a more pronounced way. In fact. In your newly published book, The Great Silver Bull, you write about, because you gave me a sneak peek at the book, I should say, for listeners, silver is the irreplaceable metal. Break that down for us.
Yeah, silver is a lot of your listeners may know this, but silver is both a monetary metal and an industrial metal. In fact, it was part of money in the US and in Canada until the 1960s, when it was completely removed from our coinage. And so, the world's had a long history with silver as money. But in the last sort of 5 to 6 decades or so, silver has really become an important industrial metal, to the point where half of its consumption, half of its use every year, more than half, goes to industrial applications. And even 10% of all silver goes to solar power, for solar panels. So, with the green revolution, the green energy revolution, silver is becoming really more important than ever. And so, in electronics, in medicine, in green energy, automotive, as I say, and things like the solar power aspect of demand, all of these certainly are pushing requirements of silver, and that all contributes to it being irreplaceable in my mind, no doubt about that.
On the silver sector supply side, with mine output, could you kind of delve a little more into the supply side and why that makes you bullish on the metal?
Absolutely. So silver has what I call, and in the book I say, silver has a quirky supply profile. And just to keep kind of simpler numbers, about 25% of silver actually comes from what we call primary silver mines that mostly mine silver. And about 75% of silver comes from mines that produce other metals as their primary metals. And so 75% of silver comes from mines that produce gold, that produce copper, that produce lead and zinc. And so the miners that produce silver as a byproduct in these cases, they regard silver as a nice bonus, not as their focus. And so even if silver prices go up and go up substantially, they have, I'm going to say, limited incentive to try and produce more silver. And even those that perhaps can make adjustments and to their systems and to their methods to try and produce more silver, and many times, if silver goes up and stays up substantially, that's what they'll wait for, to see a higher silver price and a higher sustained silver price, sometimes for as much as a couple of years, to try to make adjustments that they can actually justify. Those adjustments might in fact be doing things like mining lower grade ore rather than taking advantage. In a sense, that's taking advantage of the higher silver price. Because it's more profitable, they'll go for lower grades ore that, as I say, becomes more profitable. And they may actually turn out less silver than previously, exacerbating the high prices in silver. So it really maybe, sort of counterintuitive in that way. But these are really some of the very particular things about how, silver supply is very inelastic to the silver price. So it's not like your typical economics 101, where if you have the price of something goes up, manufacturers will produce more of it. Silver really does not act that way. And so it can, as I say, can exacerbate and lead to even higher silver prices.
Silver performs well in an inflationary environment, as your book teaches. We are in that environment right now with real inflation, at least 15% here in the States. I'm sure it's probably something similar up where you are in Canada. But if there's a recession, because there seems to be economic indicators that are flashing that we could be headed into a recession, recession, and if we have a stagflationary environment, does that worry you at all? Because silver does sometimes fall during a recession. Could that put a damper on the bull case?
I mean, my answer would be yes, in a temporary way. Yes, because obviously it's industrial applications. You would naturally expect that the demand for silver could fall off if the economy slows. But I look back to our best sort of analog is the 1970s, and I do talk about this in the book, how it, if you look at what took place in the 70s, the inflation it was not sort of rising and up to a sort of a sustained high level. What happened was it would rise, fall somewhat, not to the previous low, then rise again, fall again, not again to the previous low. So we had three large inflationary waves in the 1970s, and these were, in large part caused by central banks that would react to the inflation. They saw inflation, would raise rates, they would back off as they saw the economy sort of start to struggle again. And that would allow the economy to rise again. The inflation would kick back in, they'd raise rates again. That would slow things down again. But each time the wave was a higher wave. And if we talk a little bit about the economics of the 1970s, there's something very important to point out, and I certainly do this in the book, how in the 1970s, a really interesting comparison is that back then, the debt to GDP in the US was 35%. So that meant, much more manageable, much lower debt levels allowed the central bank to raise rates because the debt was manageable even at higher rates. Today, debt to GDP is 130%. So it's almost four times what it was in the 1970s. This is what I call the Fed's dilemma. The Fed knows it should raise rates because of inflation, but in a practical sense, it can't. It knows the government's own debt is huge at about $30 trillion. Having to, pay interest on that kind of debt at higher interest rates becomes unmanageable very quickly. And it also crushes many sectors, things like housing, which is very important, and all the periphery and related jobs. And so, in that sense, I'm less worried because I feel that the Fed has and other central banks have much less wiggle room in terms of raising rates. And to me, that means that inflation is that much more likely to get out of hand. And that's why, before we started the call, we chatted a little bit, and I said, I saw it as a defining feature of this decade. Well, I certainly see that because of what I just explained about how I see inflation, rising and potentially to some extent becoming out of control. The Feds and other central banks hands are really, really tied when it comes to this.
On the demand side, what are the investment inflows that you're observing into silver right now?
So, there, as I said, industrial accounts for more than half. It's very interesting to look at what's happened on the investment side, because I think that at the margin, it's the investment demand for silver that's going to make the big difference and really push silver prices dramatically higher. In 2020, there was incredible demand from silver ETFs. That was something like 330 million ounces. And then I believe last year it was still substantial, but it was closer to, I think, about 150 million ounces. That's likely to be lower again this year, but there's something to remember about this. And it's interesting how this relates to how inflation works. Let's just look at that for a second. So, people will say, okay, well, inflation has risen a lot, and if it slows, well, things are not so bad. But we have to remember that they are still bad, because that has led to higher prices and higher sustained prices. Unless you get deflation, the inflation has caused higher prices that are now kind of baked in. And so what we've seen with the demand side for silver, for especially from ETFs, but certainly for physical silver as well, but from the ETFs specifically, is that as the holdings in ETFs build, it's very interesting to see that even if the silver price falls, and can fall dramatically sometimes, the holdings in silver ETFs, they barely budge. And that's something that I've coined, silver is sticky money. And we've seen that, and that's going back at least a decade. In fact, it goes back to the inception of the first silver ETF, the SLV, the SIL. I'm sorry about that. The SIL, which was the original silver ETF back in 2006, that the holdings have grown dramatically and hardly ever drop. And so all it means is that as people buy into silver ETFs, they become long-term holders. And so in a sense, it's like this silver is quasi-permanently taken off the market. And so it drains the supply in a very steady way.
Interesting. So when it comes to putting together a silver portfolio, a lot of my listeners invest in the equities. They're not just, if you don't own it in your physical hands, it's not yours. That we do have that in terms of our listenership, but a lot of people like myself like to dabble in the equities. So how do you put together a silver mining stock portfolio?
So, in the book, I go into detail about that, and I talk about my ideal silver portfolio. It's my blueprint for an ideal silver portfolio, and for me, it's you certainly have an allocation to physical silver, but then you also have an important allocation to the larger silver producers. And I would even say, I would include silver miner ETFs together with large producers and royalty companies. These are sort of the almost buy it and forget it kind of silver stocks. And then from there, you've got I would say about 20% you can go to the developers and growing producers, the mid-sized. And then another 20% can go to the junior explorers. And sometimes you have, juniors that are already in the developing or producing stage, but are still a smaller market cap. And so I also say that you need to spread it around. One of the I go into chapter 53 is the 5 secrets to managing risk. And one of the big ones is position sizing. And I suggest that investors should not go beyond a certain allocation of their overall silver allocation to any one silver stock, especially in the juniors. You really want to spread it around. You want to hold, I'm going to say in silver, at least sort of 5 juniors, ideally even up to maybe 8 or 10, just to lessen your risk.
Are you bullish on the whole commodity complex in general too, Peter? And if so, what percentage are you in silver and in other commodities, if you don't mind?
So yes, I certainly am. I believe that we've started a new commodities super cycle. I think that this was due to come. I think that the pandemic and the stimulus that came from the pandemic just sort of accelerated and kicked it into high gear. In terms of allocation, I'm going to say that I'm roughly probably say 30 to 40% silver, another maybe 20 to 30% gold, and then the balance is spread across commodities, about 40% in commodities, things like energy, uranium, other metals, things like platinum and palladium, and even some of the agricultural commodities and fertilizer plays, that sort of thing.
For new mining speculators, there's so many risks that they have to learn and experience, but specifically with the silver stocks, are there any unique characteristics of silvers or risks associated with it that you could lift up for my listeners, please?
Most definitely. I would say that this probably the single most defining factor of silver and silver investments is the volatility. And so, silver is, if you just look at the annual supply of silver and the value of that, that's about 10% of gold. And gold is only about 1% of the world's investment holdings. So that tells you that silver is really a very small market. It does not take a lot of buying to move the silver market. And so, yes, it's inherently very volatile, more so, of course, on the junior side. And so, again, I do go into ways that people can manage risk. One is position sizing. I say that when you buy into a silver investment, to buy into it in tranches, split that up into 2 or 3 purchases to, again, lessen your risk. But I think that the volatility is an advantage that investors have, especially sort of smaller retail investors. We're not bound like money managers are. They have larger amounts that they have to move in and out of stocks. They have to maintain a certain amount of liquidity. They have to buy into stocks that are listed on specific exchanges. And they have to react to liquidations when clients come back and say, I want to liquidate some of my holdings in your fund. We can be a lot more patient as individual investors, and we can take advantage of, there are things, as you probably know, and your listeners probably know, there's things like seasonality, especially in North America. Around the world, depending on where the silver companies are, silver properties are, but there are the summer doldrums where things die down and get quiet in the summer. So silver stocks tend to have a weaker time at that period of the year. Then there's tax loss selling season, which is sort of late December, and where people will lock in losses to be able to write those off against gains for the year for their taxes. These are kinds of things that I talk about in the book, and that people can certainly take advantage as individual investors. Wait for periods of weakness, take advantage of that, look for mispricings. Sometimes a stock, for example, will have great results, but other things are happening, worldwide, news-wise, that will distract from that, and it won't get fairly priced. And so they can, as I say, they can take advantage of that. And if they feel or they see that the stock did not jump the way it ought to have jumped, or if it fell and it was oversold, they could take advantage and buy. If the stock didn't jump as much as they thought it should have, realistically, they can again buy. And these things go through cycles. So silver and silver stocks will get overpriced, overbought at certain periods. And in my service, I certainly tell people when I feel that it's time to, if they feel that they have, some decent gains in a particular holding. It's time to take profits. That's certainly wise as this bull progresses and matures. So there are, again, we'll go back to that. There's volatility. There's investors should take advantage of that volatility. They shouldn't let it scare them away from silver. They should make it work for them.
And they have to prepare themselves mentally going into a silver stock, because it could be a roller coaster ride on the way to a 3 to 10 bagger.
Exactly. It certainly can. But that's the reward. And you can certainly manage and mitigate that risk, as I say, through position sizing, not having too much in a specific company, by taking profits, by buying in tranches. There are certainly ways to do that. And these are all things that I talk about in the book. People will get to see, the ways that they can manage all of that. And there's so much reward from investing in silver. As I said, I talked about the gains that silver produced in the 1970s. 3,700% in the metal itself is a 37 times return. If you can get that in the metal in a massive silver bull, it's certainly not unrealistic to expect 10 to 50, and sometimes even in some special cases, 100 times or more returns in some silver stocks. I mean, we've seen that recently with some gold stocks that have gone from discovery to massive deposits that have been proven out, and so and that's very, very early in a bull market. So the potential really is huge, and it's not something to be discounted. I really feel like, given the opportunity and the economic outlook, people really need to have some exposure to silver, even if it's a smallish exposure. The upside is just so big for a small allocation to this space.
Yeah, I've been encouraging friends who've come to me, which, by the way, I'm going to buy about 5 books and just pass it out to people that have been asking me about silver so they can understand the historical thesis that you've laid out really well in this book. But I've just been telling them to buy junk silver and to buy Buffalo rounds. Don't go with the premiums, the 50% ridiculous premiums of the American Eagles. Buy something highly recognizable by others. If you need it in a bartering situation, it'll preserve your value because it is silver if it was ever tested. So that's part of my strategies. And then if they're willing to put in the work, I say, listen to my show or listen to someone like you, silverstockinvestor.com. But if they're not, I say, just buy SLIJ, buy PSLV. If you believe in the thesis of silver going up, don't come back to me if silver doesn't go up. You got to convince yourself.
That's right. I mean, we're on the same wavelength because I talk about the same things in the book. I tell people they don't have to, go as far as investing in juniors. Some people simply don't have the time or sufficient interest, and that's okay too. But don't ignore the massive opportunity of silver itself, both from the physical and even from the much lower risk ETFs, mining ETFs, and larger producers and royalty companies. And you can, one example I give in the book is Pan American Silver that, I believe it was from 2001 to 2008, produced a 16 times return. That's a 7-year time frame in one of the absolute largest silver mining companies, public silver mining companies that you can invest in.
And it dropped by 50% twice, if I recall. During that period of time, it dropped by 50% twice.
That's true. That's true. Exactly. And so, it certainly takes some conviction, to hold these companies and to realize and to maybe assess where we are in the bull market. But it's very rewarding. There's no doubt about it. It's definitely something investors and I believe every investor, even if we're talking about someone who's considerably older, really wants to take the least risk possible, I'll say go out and buy some silver coins, some from the mint of your own country, or something that's easily traded or easily recognized and bought wherever you live. That's definitely something that you want to own.
Well, Peter, it's been enjoyable chatting with you. Before you leave, where can listeners find your book?
So they can go to thegreatsilverbull.com. We're targeting May 2nd for release. And I'd like to just pull up the cover of the book. We can show readers what that looks like. So here you go. That's the Great Silver Bull. As I say, Amazon, or you can go to thegreatsilverbull.com to keep track of any developments with the book. I encourage people obviously to go in and have a look. I think that I like to think I've put something really unique together in terms of the opportunity in silver and how to take advantage of that opportunity in the silver space.
And I will put links to Peter's website, his subscription service, and where you can find the book in the show notes below. So just click below to find more information. Peter, thanks for coming on the show and sharing your insights today.
Bill, it's been a tremendous pleasure, and thank you so much for having me.